In this lecture, we will go over a summary of Level 1 fixed income securities defining elements. Let's just understand the basics over here. When you buy a bond or you invest in a bond, what are some fundamental features of a bond? One important feature is the issuer. So who has issued the bond? Is it a particular sovereign government? Is it a particular corporation? So obviously the issuer and the description of the issuer is on the bond. Then the maturity. So if the bond is issued on 1st January 2010, then the maturity also needs to be stated. A 10-year bond would mean that from issue, the bond matures after 10 years. Par value, that is typically either 100 or 1000. Par value is important because the coupon rate is calculated as a percentage of par, and the par value is returned at maturity. Coupon rate and frequency. The bond will also specify a coupon rate. So for example, if a coupon rate is specified as 10% and the frequency is 2 times a year, then this means that every 6 months a 5% coupon will be paid. 5% of 100, which will be 5. Currency denomination is also specified. So the bond could be denominated in dollars or euro or some other currency. So these are the most important features of a bond. Current yield or running yield, this is something we'll also see later, but very briefly. If you buy a bond for 100 and the coupon payments that you expect to receive over the next year are $10, then the current yield is this $10, what you expect to receive, divided by the current price. Yield to maturity is an important term. This is also called yield to redemption or redemption yield. This is your yield assuming that you hold the bond to maturity. The bond indenture is also called the trust deed, and this describes obligations of the issuer and rights of bondholders. It includes information related to the legal identity of the bond issuer and its legal form, the source of repayment proceeds. So this document tells the investor where the money will come from. So obviously the investor will receive coupon payments and then the par value back, and the bond needs to specify where that money will come from. Asset or collateral backing. Some bonds have an asset or collateral backing. If that is the case, then it needs to be specified what is that collateral. Credit enhancements. These don't always exist, but at times an issuer with a low credit quality might get insurance or might do things that enhance the credit rating of the bond, and those need to be specified as one of the covenants. So those need to be specified in the bond indenture. And finally, we have covenants. So these are the terms which from a testability perspective are very important. Recognize that we can have either affirmative covenants or negative covenants. Affirmative covenants indicate what the issuer must do. These are generally administrative. For example, the issuer will make payments on time, comply with all laws and regulations, maintain current lines of business, insure and maintain assets, pay taxes on time. So notice that these are things that the issuer would probably do anyway. Negative covenants indicate what the issuer must not do. These are frequently more costly and materially constrain the issuer's potential business decisions. And examples are shown right here. Restrictions on debt, in other words, restrictions on how much more the issuer can borrow, negative pledges, restrictions on prior claims, restriction on distributions to shareholders, restrictions on asset disposals, and so on. So on the exam, if you get a question related to this, remember 2 facts. In a negative covenant, the issuer will be told, or the issuer will say, these are the things I cannot do. That's one point. And the second most important point is that negative covenants are more material relative to affirmative covenants. Legal, regulatory, and tax considerations. Fixed income securities are subject to different legal and regulatory requirements depending on where they are issued and traded. So these are the important points from a testability perspective. Take a given bond market, such as, let's say, the Japanese national bond market. So in the Japanese national bond market, there will be domestic bonds. These are bonds issued in the Japanese bond market by Japanese companies. And then in the Japanese bond market, you might also have, let's say, American companies such as General Motors issue bonds. So if General Motors issues a bond in Japan and that bond is denominated in yen, then that would be part of Japan's national bond market, but the categorization of GE's bond or GM's bond, the American company's bond, will be that it is a foreign bond. It's a foreign bond in the Japanese market. Then another category is Euro bonds. You can think of these as bonds in the international market. They are less regulated than national bonds. So they do not fall under the jurisdiction of a particular country. The major advantage is that the degree of regulation is less. So you might have a company based in Italy that issues a dollar denominated bond in London. So that would be a euro bond. You can have euro dollar bonds or euro yen bonds. So euro doesn't mean the currency euro. Euro is just a term that essentially means international. Tax considerations. The income portion of a bond investment is generally taxed at the ordinary income tax rate. So this is a straightforward concept. Let's say you buy a bond and you get a coupon payment. That coupon payment is considered your income, and in most countries that coupon payment will be taxed just like your ordinary income is taxed, and at the same rate as your ordinary income. Capital gain tax might be different for long-term investments and short-term investments. So in many countries, the tax code is such that capital gain tax rate is different from the ordinary income tax rate, and within capital gain, the long-term capital gain tax rate is often different from the short-term capital gain tax rate. And this is very similar with equity investments also. In some countries, prorated portion of discount may be included in interest income, and this is called the original issue discount provision. This is true in the United States, and there are questions and exhibits in the curriculum that deal with this scenario. This scenario is covered in our examples, which have been shared with the crash course participants. But simplistically, the idea is this. Say you are an investor and you buy a 5-year zero coupon bond. Obviously, over the 5 years, you are not getting any income, but since it's a zero coupon bond, obviously you bought it at a discount, and over 5 years, the book value of this bond is going up. So the capital gain is taxed. So that is the idea here with the original issue discount provision. Principal repayment structures. What we are talking about here is the fact that when a company issues a bond, then obviously it is borrowing money, and over time it needs to repay. And there are different ways in which the borrower repays the principal. One mechanism is called a bullet bond, where the entire principal amount is paid at the end. So if we have a 5-year bond, then what's happening over the 5 years is that the issuer is paying interest, and if the par value is 1,000, then that 1,000 is all paid at the end. And this is called a bullet bond because that whole principle is like one bullet all at the end. The opposite of a bullet bond is a fully amortized bond, where the structure is that the issuer pays a certain fixed amount every period. And this often happens with mortgages. When a homeowner takes out a mortgage loan, then the homeowner is going to often pay back a certain fixed amount every month, and that fixed amount includes both interest payments and principal payments. The portion of interest and principal will vary, but the total amount stays the same. Then you can have partially amortized bonds. These can be viewed as a combination of an annuity and a balloon payment. With partially amortized bonds, what happens is you still make a balloon payment at the end, but the balloon payment is less than what you would make with a pure bullet bond, and you make a certain fixed payment throughout. So the fixed payment throughout is less than what you would make with fully amortized, and the balloon payment at the end is less than what you would make in the first scenario. The curriculum has numerical examples related to how this works, but I've given you the core concept. Sinking fund arrangement specifies the portion of the bond's principal outstanding that must be repaid each year through the bond's life. Some bonds, when they are issued, they specify that repayments will happen per a certain schedule, repayments of principal. And that schedule or that arrangement is called a sinking fund arrangement. A sinking fund arrangement reduces credit risk for investors. So you can see that the highest credit risk is with a bullet bond, because there is this large amount that needs to be repaid at the end, and obviously there is a risk that this large amount will not be paid at the end, that there might be a default. When we have a sinking fund provision, then that principal is being paid back earlier or per a schedule, so that reduces credit risk. But there is higher reinvestment risk, because now the investor will get money back sooner, and the risk is that interest rates will go down, so the money that the investor gets back will then have to be reinvested at lower rates. Now we come to coupon payment. Now we come to coupon payment structures. The most basic structure is a fixed period coupon, and this is largely what we've seen. If the fixed coupon is 10% paid 2 times per year and the face value is 100, then every 6 months a fixed coupon of 5% is made. Floating rate notes, here the interest rate varies. So the most basic kind of a floating rate note says that we have a reference rate such as LIBOR, and for a given period we look at LIBOR at the start of the period, and then the reference rate could be LIBOR plus, let's say, 2%. So the coupon payment made at the end of the period is based on the reference rate plus a margin. If LIBOR is 5% and 2% is the margin, then the rate paid is 5% plus 2%, which is 7%. If these are semi-annual payments, then it would be 7% divided by 2. An important point to note is that with floating rate notes, there is a relatively low interest rate impact. In other words, if interest rates go up, then with a regular fixed period coupon, the price impact is quite large because the cash flow is fixed. When interest rates go up, the price will come down. With a floating rate note, when interest rates go up, then the coupon payments also go up, and they are being discounted at a higher rate, but essentially both our numerator and denominator are going up, so the impact is less. Floating rate notes might include a cap or a floor, the point being that if interest rates such as LIBOR keep going up, then that's a problem for the issuer. And to reduce his risk, what the issuer might do is say, okay, this is a floating rate security, but with a cap. To protect the investor, there might also be a floor which says that if rates go down, then based on a certain floor, the rates will not go below that floor, or the coupon payment will not go below the floor. An inverse floating rate note has a relationship such that when interest rates go up, then the coupon payment goes down. So if you have a structure like this, where the coupon rate is 10% minus the reference rate, then notice as the reference rate goes up, then obviously 10 minus the reference rate comes down. A step-up coupon bond is one which says that initially the coupon rate is low and then slowly the coupon rate goes up. Credit-linked notes are notes where the coupon rate changes if the credit rating changes. You as an investor buy a bond, let's say that the bond has a AA rating. Now after that, for some reason the bond is downgraded, so from AA it comes down to an A. With a credit-linked note, the coupon rate will go up when the rating comes down, because the risk has gone up. You as an investor don't like that. To compensate you, the rate goes up. Payment in kind coupon bonds, these allow the issuer to pay interest in the form of additional amounts of bond rather than as cash payments. Now this is a long laundry list and you can try and remember this, but I believe that from a testability perspective, it's important to understand what aspects of what we are talking about benefit the issuer and what benefit the investor. So if you think about it, this payment in kind, does this benefit the issuer or the investor? This is good for the issuer. Deferred coupon bonds, these allow the issuer to defer coupons. So you can think of a manufacturing company that has a long lead time before the plant becomes operational. So what they might do is issue a bond where they say that for the first 3 years we will not make coupon payments. So interest accrues, but the first coupon payment is made 3 years later. That would be a deferred coupon bond. Index-linked bonds, also called linkers, generally these are bonds that are linked to the inflation rate, and mostly it is the CPI, though in some countries it could be some other index. With index-linked bonds, broadly speaking, there are two major subcategories. One is interest indexed, where we say that the coupon rate is adjusted based on inflation, and the other is capital indexed, where the par value is adjusted based on inflation. And in the examples, we actually look at relevant scenarios. Bonds with contingency provisions. There can be several contingency provisions, but the three major ones that you need to be aware of are call provision, the put provision, which will correspond to a puttable bond, and convertible bonds. A callable bond gives the issuer the right to redeem all or part of the bond before the specified maturity date. This is beneficial to the issuer because it protects against a decline in interest rates. Callable bonds offer a higher yield and sell at a lower price relative to otherwise similar non-callable bonds. So obviously something that's good for the issuer and not so good for the investor then will have to sell at a lower price. Lower price means higher yield. You as an investor will demand a higher yield for something that you don't like. A puttable bond gives the bondholder the right to sell the bond back to the issuer at a predetermined price on specified dates. This is beneficial to the bondholder. Puttable bonds offer a lower yield and sell at a higher price relative to otherwise similar non-puttable bonds. A convertible bond is a hybrid security with both debt and equity features. It gives the bondholder the right to exchange the bond for a specified number of common shares in the issuing company. Advantages to the bondholder. And this is the major one: ability to participate in equity upside and downside protection. The point being that if the bondholder has this convertible bond and the stock, the equity, common equity of the issuer starts going up, then what option does the bondholder have? The bondholder has the option to convert into common stock. So this is sort of like a call option. The bondholder will exercise this option if the stock price starts going up. What if the stock price starts going down? Then the bondholder will hold on to the bond and keep receiving coupon payments. So that's the advantage to the bondholder. Advantages to the issuer: reduced interest expense, and elimination of debt if conversion option is exercised. Now, do you think if I am the issuer, can I issue a convertible bond at a relatively lower interest rate? I can. The reason is I am giving you, the investor, something that you like. So obviously if I'm giving you something that you like, then I can get away paying you a lower interest rate. So that is the major advantage to the issuer.